The 26 federal budget just fundamentally re-engineered Australian property investing, and the backlash continues to be absolute chaos. By completely killing negative gearing on established homes while shielding new builds, the government didn't just break a massive election promise. They split the housing market into two. If you are an everyday investor relying on the classic property playbook to build wealth, then your financial world changed on July the 1st, will change on July the 1st, 2027. Effectively, it's already changed. The sentiment sweeping across the financial sector and the property industry isn't just negative, it's radioactive. For decades, the standard path to middle-class financial freedom was really quite simple. Buy an affordable property, use negative gearing to improve your holding costs, supply the rental market, build equity, and repeat. But with one very aggressive sweep of the pen, the government has turned that pipeline into an exclusive and highly restrictive landscape. Hello everyone, I'm Kate Hill, and if you're ready to build real wealth through smart and no-nonsense property decisions, then you are absolutely in the right place. Let's look today at why the 2026 budget's taxation shake-up is fueling absolute chaos. Okay, so let's look past the political spin and focus strictly on the raw maths. From the 1st of July 27, properties owned prior to budget night are safely grandfathered from a negative gearing perspective. But if you acquire an existing residential property after that cutoff date, then you can no longer offset your net rental losses against your personal salary or wage income. Instead, those losses get trapped, they get carried towards the future. Meanwhile, brand new builds get a free pass. Investors buying fresh construction keep their negative gearing privileges intact, and they get a preferential choice when they sell, opting between the traditional 50% capital gains tax discount or the newly revived inflation indexation model. For everyone else, that 50% blanket CGT discount is dead, replaced across the board by an indexation system that features a 30% minimum tax floor on real gains. And let's just have a very quick financial reality check. Independent financial modelling reveals quite the gap here. An investor earning a very standard $100,000 salary who purchases a $1 million investment property will end up roughly $248,000 better off over a 10-year period simply by choosing a brand new build over an established home. For top-tier income earners, that tax-driven disparity widens to $280,000. So this seems to be the Treasury's theoretical goal. Starve investor demand for existing homes so that first home buyers can sweep in without competing against those deep pockets, while simultaneously forcing investor capital into new housing supply. But this logic completely crashes when it collides with actual real-world development economics. Property developers do not construct apartment blocks or sprawling house and land estates out of just pure goodwill. They need commercial bank loans to turn that dirt. And banks explicitly, or they have done until now, demand pre-sales, often requiring quite a high percentage of the construction debt to be locked into unconditional contracts before authorizing a single dollar of funding. First home buyers don't often buy off the plan blueprints. They have immediate lifestyle needs. They have leases to manage, and they want to walk through a completed front door within 30 to 60 days. They can't necessarily afford to lock up their capital and wait 2 to 3+ years for an apartment block to be built. It's the private mum and dad investors, syndicates, wealth builders who absorb that risk and sign off the plan contracts. When you aggressively suppress overall investor confidence across the country, you don't magically isolate the new build sector. investors pull back entirely. If pre-sales dry up, developers can't clear their bank funding hurdles. Projects get scrapped and the pipeline of new housing completely stalls. This is anecdotal. This is actually happening. In fact, the government's own Treasury papers quietly admitted that these changes could actually shave 35,000 dwellings off Australia's national housing supply over the next decade. Talk about a self-inflicted wound. And as if breaking the property pipeline wasn't enough, the budget sneaked in a massive structural blow to many wealth creators. Beginning July 1st, 2028, a flat 30% minimum tax floor will apply to all discretionary family trust distributions. This effectively guts the legal strategy of tax streaming, where trust income was distributed to family members in lower marginal brackets to minimise exposure. All these things could change, of course, over the coming few months as they thrash all this out, but that's how it stands at the time of recording. Given that private family groups and private developers rely heavily on these trust structures to pool capital and manage risk, this change adds yet another layer of friction to an already exhausted industry. Furthermore, we are about to witness a profound lock-in effect across the established residential market because existing properties are grandfathered. Current property owners are quickly realising that selling their asset means entering a brand new, highly punitive tax landscape on their next purchase. The logical response is that landlords will simply refuse to sell, freezing transactional turnover. A turnover that has already been very suppressed over the last few years. And for any new investors brave enough to buy established real estate without the cash safety net of personal tax deductions, they will have no choice but to hike rents to try and bridge the cash flow gap. Of course, you can't just hike a rent by $100 a week. So once again, the everyday tenant is left holding the bill for short-sighted fiscal policy. Thank you so much for watching, everyone. If you're serious about building real wealth through smart and well-researched property decisions, then stick around. There is a lot on this channel to support your journey, and I will see you in the next video. Bye.